Hey guys, I know you're watching this on YouTube right now, and I know that 85% of you are not subscribed to our channel. So hit the like button, hit the subscribe button, leave us a comment.
Be sure to visit makemoneycount.com to find all of our old episodes.
Hey guys, how's it going? Hope everyone is having a great week. Depending on when you're watching this, weekend, weekday, whatever the case may be is.
What a good intro that was. It's Sunday today. I'm just happy that you guys came in.
Yeah.
Matt, you're the best. Thanks for coming in.
Thanks, Matt.
Thank you. No, it was. I'm glad to get it done. It means that we'll have a new episode out on CHCH this weekend and for the new listeners this week.
Nice.
You know what worries me though, Matt?
What's that?
No green t-shirt.
Yes. I know you want me to be a talking head.
Yeah. Can you just show yourself on the camera for a
Yes.
second? Yeah. Like if you had a green t-shirt right now, it would just be this floating head. Green t-shirt, green mic also.
Okay, I'll work on it.
Yeah, I'm going to order a green t-shirt by the end of the show so that it's ready.
Yeah, good.
For next episode.
Yeah.
Today we're going to talk about a few things. I'm going to get us started with a topic that I'm very interested in and kind of enrages me in my soul a little bit. So
There's like, what is the topic? The increase in the price of French fries?
No, it's the fact that there are people all over Canada right now that are going to their banks, that are scared about the market, that are taking a fixed rate, even though the bond yields are dropping.
Right.
So basically, everybody who's taking a fixed rate right now from their bank is lining the pockets of the bank. And I want to know your opinion on why you think that is.
Why are people lining the pockets of the bank?
Well,
why is the bank profiteering?
Profiteering, yes.
Okay, so I mean, like, first things first, let's all understand the banks are not designed to help their borrowers or, frankly, the people that are providing them with capital for deposits.
Right.
Okay? The bank's priority is to their shareholders. So it is to their profitability. It's just the way the public markets are designed.
Yeah.
So if the bank has an opportunity to increase their profits by increasing the spread that they can earn, or they call it net interest margins, right? Mm-hmm. The difference between their cost of capital and the price that they can lend it out for. The moment the bank has an opportunity to increase that spread, they're going to do it. They don't want to do it sacrificing market share in most cases, in most kind of economic environments. And that's why you see a level of collusion between the Canadian banks.
Right.
Right? Like there is nothing that illustrates this more than the consumer just has to go and look at what the 5-year fixed rate is at all of the different banks in Canada.
Mm-hmm.
It's exactly the same.
Right.
You know what else is the same?
What?
The 4-year.
Yeah.
And the 5 and the 6-year.
And the 3-year.
And the 2-year.
And the 7-year.
So how is it that every single rate from every single bank is always the same as the other banks?
Yeah. That's
collusion, right?
Mm-hmm.
Same reason why every gas station has the same price for gas. It benefits them.
Mm-hmm.
Every once in a while you'll see a spike or a drop in a rate from one bank, a special, because they're trying to conquer a little more market share. But for the most part, they are working together to create a stable marketplace. They don't really want to increase or decrease their market share too much. It doesn't look good even right now to go to your shareholders if you're a bank and say like, we increased our residential mortgage portfolio by 7% because we dropped our interest rates.
Mm-hmm.
The investor may take that as the bank being too cavalier with their deposit holders' money, maybe subjecting them to a loan loss. Anyways, This is like a bit of a roundabout answer, but to answer your question, and I'll answer both of them. Okay. So the first question being, why are the banks profiteering? They are responsible to their shareholders. Mm-hmm. We are in an interest rate increasing environment right now. When interest rates are increasing, it is very easy for the banks to increase their mortgage rates. People are seeing it in the news. They're hearing about it. It makes sense. My mortgage rate went up. makes sense to me.
Yeah, rates are up. Mortgage rates are up.
And what the consumer should always be aware of. I mean, listen, we say like what people should be aware of, but like how many people are going to monitor bond yields, right?
Yeah.
Bond yields are dipping. So if a 5-year bond yield is dropping and a 5-year fixed rate mortgage is increasing, there is nothing else in that spread other than profit taking. And there's clever ways to frame that, right? A lot of the banks will say, well, we're not really profit taking. We're just affording ourselves a little more margin for instability in the future. So, loan loss provisions, or like, the market's a little risky. So we're insulating ourselves from what might happen in the future. Make no mistake, that's still profit taking.
Right.
There are still loan loss provisions on the financial statements of that bank that account for losses. And they do that on a quarterly basis. So it's profit taking.
Right.
And it's to please their shareholders. And the bank stocks are doing well in the face of that. The shareholders, albeit are timid because they do view a recession coming up. And we can talk about how the bond market's showing that. You come with questions. I come with like little things that I want to talk about for the show, right? So there's like 3 things that if I can slide them in somewhere, if I can slide them in somewhere, I'll do it. Anyways, to answer your other question, why do people do it? So we know why the banks do it. Why do people do it? It's comfort, man. It's your bank. And as much as we try, I've been doing this for 22 years. As much as we try to convince the consumer that it is not in their best interest to deal directly with their bank on anything, let alone on everything, because most Canadians feel like they're going to insult their banker if they don't send their banker everything. Well, if I don't give my banker the first shot at my line of credit, then he's going to be upset with me, or she's going to be upset with me, so they won't give me a good rate on my mortgage. And if I don't give them all of my savings account, then I might have to pay more on my RRSP. First of all, you're not allowed to cross-sell in Canada. Like, it is against FSRA's rules. No tide selling. And second, the Bank of Canada issued a report. We used to talk about this a lot more.
Yeah.
Bank of Canada issued a report that said, if you want access to all of the stimulus that's being provided in the marketplace by the Bank of Canada, don't just deal with one bank. So as much as we try to get the word out that the consumer should ask questions of more than one bank, should engage a broker. Listen, it doesn't have to be Cannect. We're just a broker to help you. That's the only way we're going to help consumers, number one, get more of the fiscal stimulus that's being injected. Now it's not being injected, it's being pulled back.
Yeah.
But to get them a purer rate, right? To not see the type of profiteering that it's just naturally going to happen in an environment.
Right.
Any environment that's, capitalist. These aren't mandated rates, right? It's market.
Yeah. And it's an interesting fact to just point out that, like, when we discuss this issue, we're talking about banks, right? We're not talking about your monoline lenders like First National, MCAP, RFA, like all these guys that you can only get access to through a broker, right?
Yeah.
So just kind of harping on what Marcus said about,
Yeah, listen, monoline lenders are still in the business of making a profit.
For sure, yes.
But they have to make a profit by engineering their cost of doing business down.
Right.
So guys, just to slow it down for a second, the average viewer might not know what a monoline lender, what we mean by that. Like, we're talking about lenders that only lend on one thing, and that means a mortgage. So you can't walk in and open up a checkings account or a savings account. Their only access is through a broker, right? Like, that's what we're explaining to these. That's a very industry term that I don't think a lot of people realize, that there's these lenders that even exist in the market.
I can't hear Matt because he's not wearing a green T-shirt. Yeah, that's a good point. They do one thing, they do it very well. They were clobbered when the government of Canada instituted a rule whereby CMHC was no longer able to provide portfolio insurance. I don't know if you remember that. It's a while ago now. It was when Morneau was the finance minister. The kind of first act of business, first order of business as soon as he got in there, was they said CMHC, which is a government entity, Crown Corporation, can no longer offer insurance to monoline lenders, or any lender for that matter, on mortgages where the value of the property is over $1 million or where the consumer has more than 20% equity. And what that did is it did two things. Okay. It really hurt the monoline lenders, but it very clearly showed how the monoline lender was keeping the marketplace in check.
Right.
Because now the interest rates on mortgages where monoline lenders are competing, read CMHC insured mortgages, Sagan or Genworth, whatever they're calling themselves now, Canada Guarantee insured mortgages.
Sagan, tomato,
who knows? But all of those insured mortgages have lower interest rates than the mortgages where the monolines don't compete anymore.
Right.
And then the monolines had to get wholesale line of credit from banks in order to compete in that market. So the banks were just able to spike their profit margins. Right. Again, profiteering, using the government, lobbying the government properly, getting the government to enact something. I mean, it's not something that we're going to stop seeing.
Right.
Right. But yeah, monoline lenders are very helpful for the market. It's a free market, right? And a monoline lender, if they're able to operate in the market, a monoline lender can do a lot of good.
Right.
Unfortunately, the government of Canada likes playing around with the rules.
Right.
To the detriment of the Canadian consumer.
Right. Yes.
The only person that hurt was the Canadian consumer.
Okay. So we get a lot of responses to our Instagram videos.
A lot? You mean like 3 or 4?
To our Instagram stories. But we encourage you to comment any questions that you might want to have answered, about the market, or where Marcus gets his shirts cleaned. Like, it doesn't matter. Just post it and we'll ask it on the show. He cleans his own shirts. I'll ruin that one.
Yeah, I don't take him to a dry cleaner. Rip off.
Which I stopped doing.
Rip off.
They just break your buttons. You, Wayne. But
other than Wayne, the dry cleaner next to the King Street office is the best, but they just break your buttons.
King West Cleaners.
Yeah.
Shout out Wayne.
Yeah.
So I'm going to go to one of my questions here that I have. So I've been listening to a lot of things you've been saying over the past few weeks, and was wondering if there's any advice that you can give me, the average listener, on how to get ahead in today's market. Like how to make money. Like what in a scary market, how does one make money?
Okay.
Go.
So the reason why that's a good question.
Okay.
Is so you never make money when you sell something. You always have to think like this. Mm-hmm. You always make money, or you only make money when you buy something.
Right.
And in times of crisis, there is always opportunity, right? I mean, Matt is probably going to be like, there's a Japanese word. Do you know that crisis and opportunity is the same word, right, Matt?
No, I'm not that smart.
You're pretty smart.
Thank you, Marcus.
That is very smart.
But you make money when you buy things because you take a risk. Mm-hmm. And you buy something when few others are buying it, right? There's a demand-supply relationship to everything that we invest in, purchase, sell. And I do not think that we have reached the point where it is a time to enter the real estate market right now. Like, I think it's like, but I can tell you that if you were sold 100% on buying something 1 year ago,
right,
and whatever that asset was, you should be considering it now.
Right. Yes.
Right. If you hold a stock and you have a lot of conviction in that stock, you should be buying a little bit of it right now.
A firm?
I mean, like you're into a firm.
No, but we can use an example that everybody knows. Disney about 2 years ago was
great.
Disney about 2 years ago was about $90. It went about to 200. Now it's back down to about 100. And if you believed in it, anytime throughout that point, it's got a discount now.
They did have a really good week, I think.
Yeah, they did.
Yeah.
You know why?
Why?
I think they added 14 million subscribers.
Wow, that's crazy.
I think that I read that somewhere. I was like, how do you make money in this market? Get ready to deploy capital. How about this? Like, some of the largest asset managers in the world, I think actually the largest asset manager in the world, BlackRock, is just raised a $50 billion opportunity fund to invest in residential real estate.
Right. Interesting.
So they're obviously preparing for something. They know a lot about the marketplace. They just did a big investment in crypto through Coinbase. Matt, you should be so happy to hear about that.
I am.
But like big asset manager, big investor taking stabs now, right?
Mm-hmm.
Not buying things at the top of the market. So if you've waited this long to start deploying capital, you got to start considering deploying capital, right? How do you make money in a market like this? You are patient. You have been patient so far, which is a critical piece of making money.
Mm-hmm.
And now it is time to seek out opportunities,
Right.
and to prepare to deploy your capital, and to do so with conviction.
Right.
Like, I mean, I don't know. You read like these Stoics, like old quotes of philosophers, even the kind of habits of successful people right now. There's kind of two, I don't want to say conflicting, I'd prefer to almost say complementary characteristics. One is intuition and the other one is fortitude. So like you have to be intuitive so as to react to changes in the market and to understand, you know, when your gut is telling you that something that you're chasing might not be correct.
Right.
But you also need the fortitude to trust that your instincts initially were correct.
Yes.
And those two things, if you have a lot of kind of anxiety and uncertainty, those two things can counterbalance and throw you off.
Right.
You can think, you know, geez, it's my intuition or my instincts that are telling me that I should no longer buy the triplex that I was looking at down my street when the market was at its peak and it was $2 million, even though it's 1.5 right now.
Right. Like, don't get too excited.
What do you mean? Don't get too excited.
Why don't you just play that back and then just continue on with what you're saying?
No, like, listen, excitement is okay.
Right.
We don't have to play it back. Excitement is okay. What isn't okay is if you are riddled with anxiety and self-doubt, it is very difficult to maintain fortitude. And it can be it can kind of overrun your internal intuitive heuristic kind of mechanisms for creating opportunity for yourself. Mm-hmm. Because you can kind of stymie your growth. You can be like, and it's also really easy to justify either doing something or not doing something at the wrong time. And I'll explain to you why I think this. It's super easy to tell yourself when the market is dropping, oh, you know what? This isn't the time because I read the newspaper and the newspaper says no one's buying and the market's getting worse. And likewise, it's easy to tell yourself this is the time to buy because the newspaper and the media and all my friends are saying you have to get into the Toronto real estate market because prices keep rising and they're always going to keep rising.
Right.
So it's really easy to make the wrong decision because groupthink surrounding us is guiding us in one direction. It is very difficult to move in the other direction against all of that groupthink. So the people that are successful, that make money in any marketplace, are the people that are, for lack of a better analogy, the salmon that are swimming upstream.
Right.
The problem is a bad analogy because they get tired and then the bears just eat them. But that's why it's a bad analogy. But like you should strive to be the salmon that not only has the energy to make it upstream so that you can lay your eggs, but also the salmon that does not get swiped by a big bear claw.
Yeah, like the salmon that makes it through.
Which is actually a pretty good analogy when you think about the bear market. So if you're able to get up that stream,
Oh, wow. Good job. See, I told you were smart.
yeah. See, if you're able to get up to the top of that stream, lay your eggs, get out. And the truth is, like, there's a great chart. Everybody can just Google. Maybe I'll throw it up on the screen right now for everybody. It's called the Wall Street Cheat Sheet, and it really just shows that these peaks and falls are just based off human emotion in the market. The belief and disbelief in the fear in an open market, where people are able to openly sell and buy in an open market. You have to be the opposite of that to be able to capitalize in these things. If the majority of the market is selling, when things are at their lowest, that's when you buy and make your money.
I had coffee with Bruce Langstaff this morning. Like, kind of guy that's managing capital markets for Cannect.
Mm-hmm.
It's a very smart guy.
Mm-hmm.
He follows a guy named Howard Marks very carefully. Howard Marks, I think, is his name.
Okay.
And he talks about the market being a pendulum. So, the market is always kind of moving. This pendulum is moving, right? And it's never really like bingo right in the middle. It either swings too far out, like too exuberant and too excited and too optimistic, or it swings fearful, pessimistic. Right. It's like greed and fear, as Matt's saying. And it is much easier to make money if you are buying something when the pendulum is swinging somewhere in the fear range.
Of course.
In the pessimistic range. Because wherever you get it, it doesn't have to be like the furthest out point. Wherever you get it, you're going to make money when the pendulum swings in the other direction, which it always does.
Right.
Well, the way you lose money is by buying when the pendulum is in the opposite direction.
Right.
Like heavy on the greed index, heavy on the optimism index. And I will say that the public markets are always skewed towards optimism.
Mm-hmm.
That helps you if you want to buy on the fearful side. And then the other way that, like, I personally manage to lose money in these markets is I always try to short when it's too optimistic.
Mm-hmm.
And then I am always surprised at how much more optimistic it could get. So again, making money in this market, I think, takes a combination of kind of this intuition and heuristic analysis, like gut instinct, not guts, but gut instincts, and then guts, fortitude to see through what your investment thesis is. Right. If you can't properly mix those two things together, you're screwed.
Right. Yeah.
Because you're either going to be filled with self-doubt and you're going to be misguided because you're going to be thinking, oh, my idea was wrong. Everyone else is saying
so
it's
stupid.
wrong. Yeah, I'm not going to do it. I'm going to wait. And then you may be waiting and then the market's going to head exuberant and you're going to be like, oh, man, I totally should have done that back then. And I'm going to get in it now. And then you get into the wrong time.
Yeah.
So, I mean, listen, be prepared. There are opportunities right now. And I can tell you, like, there are people I speak to every day where they were willing to buy something for $2 million and now it's 1.5 and they're like, oh no, market's going to drop a little more.
Yeah.
If the stock market is a leading indicator for what's happening, then it's probably time to buy because the market had a great run, right?
Yeah.
But I would caution people to say that there are so many variables affecting what's happening in that market right now. Namely, the market ran up, and we spoke about this a little bit. The market ran up because people expect inflation to be decreasing now. Not significantly, right? But just not increasing as quickly as it was. So my thought on this right now is that although it may help us in the short to medium term, it could negatively impact us. Like if we see asset prices come up a little bit now, I still think we haven't really settled on a bottom.
Yeah. It's still murky.
Yeah. But if you listen, long-term it's very easy for long-term investors.
Yeah.
Right? Long-term investors, you want a triplex, you're going to hold that for a long time. In the future, it will be worth more than what it is right now.
Yeah.
Just depends on when in the future.
Yeah, me and my brother had this conversation yesterday, and it was like, if you're comfortable holding something for 3 to 5 years, then it's the right time to buy, right?
3 to 5 is a bit of a tight timeline, but sure. I think you might be right. Yeah.
6 to 7.
It's just like, listen, the bond market's telling us we're going into a recession.
Right. Yes.
Matt put up the bond thing. I told Matt, this is one of the things I wanted to slide in. Okay. There is something called an inverted yield curve. Okay. This is what we're looking at right now on the screen is nothing, actually. No, now, what we're looking at now on the screen is 1 year's worth of comparison between the yield on the 10-year Government of Canada bond and the yield on the 2-year Government of Canada bond. This is from the Bank of Canada's website. So you will notice that in July, roughly speaking, maybe, what is that, July, I don't know, 2nd, 3rd, 4th, who cares? The yield on the 10-year Government of bond fell below the yield on the 2-year. That is called an inverted yield curve.
Mm-hmm.
It means that investors in the bond market are saying, sure, I believe that for the next 2 years, interest rates are going to be high, but I also think that after that and long term, interest rates are going to go really low.
Right.
So if for me, I can't believe, like that 10-year, if I can get 3% on 10 years, I'll take it.
Mm-hmm.
Right? I'm willing to shelter my money because I believe after this next 2-year stretch of increasing interest rates, we are going to need to re-stimulate our economy with low interest rates because we're going to be in a recession.
Right.
So for that reason, I'd be concerned to say, now's the time to buy something.
Right.
Right? I don't love seeing that inverted yield curve and telling people to deploy capital.
Mm-hmm.
When people are sheltering 10-year money today for 3% and they're demanding less than what they could shelter 2-year money for.
Right.
It's kind of like a 5-year fixed rate. Like, how we tell people, hey, you've got a 5-year fixed rate. It's at 3.7 and you got 2 years left on it. But interest rates are so low right now that we used to say this. Don't say this anymore because interest rates are higher. But it might make sense for you if there's savings associated with breaking your 5-year fixed rate and going into a new 5-year fixed rate at a lower interest rate. If there is even marginal savings, like $500 worth of savings, it might make sense because you get to lock in that new 5-year fixed rate for 3 additional years.
Yeah.
You're not going to ride out 2 more years on your 5-year and then end up in a market where interest rates are significantly higher.
Of course, yeah.
You're going to be able to kind of blend down. This is the opposite conversation when you're speaking to an investor in bonds. You're saying, hey, listen, I know you can get 3 points on your money for 2 years or whatever it is, like 345. I don't know, like the specifics, but let's say 3%. I know you can get 3% on your money for 2 years, but in 2 years, you'll have to reinvest that money.
Right.
And what the market's telling you is we don't think the rates are going to be 3 in 2 more years.
Mm-hmm.
So you can also choose to take a 10-year and earn 2.8 for 10 years.
Right.
Which won't be available in 2. So this kind of makes things a little bit scary. There's a few things, right? Like that tell you now might not be the time and that we are likely headed for lower asset values. The bond market and some really big institutional like investors like BlackRock who are putting together funds now to buy real estate, to buy residential real estate. Like, yeah, that's like, no bueno.
Can we also point out that the last time that these charts went inverse like this was just before the last recession?
I don't think you should point that out. You already pointed it out. Who cares? No, that's for sure a good thing to point out, Matt. The last time
it's just because you don't have a green shirt on, by the way. Like that is
Yeah.
the only reason.
Matt, you need a green shirt.
I'll go work on that.
Listen, interest rates are going up. I was like listening to this Wall Street Journal podcast about affordability on houses. Affordability in the States for housing has never been worse than it is right now because prices are still kind of sitting at those lofty levels. Interest rates have spiked. Monthly payments are harder to make. It's like getting tough out there. Well, listen, in Canada, 75% of our wealth is in real estate.
Yeah.
And they say 10%. I think it's probably closer to 15 or 20% of our GDP, of our gross domestic productivity, real estate.
Right.
Probably more. There were months in the last 12 where half of all the growth for our entire country was coming out of residential real estate.
Right.
There is a heavy reliance of the Canadian economy on real estate. Just because the central bankers have now switched gears to say inflation is the problem, don't worry about a recession, doesn't mean it's going to feel any better when we get into a recession. Well,
Yeah.
which I think we are in a recession, regardless of what the stock market in the States is telling us right now, which is really like the stock market of the world. Like, let's face it.
Yeah,
right?
yeah. And when we were gone, there may or may not have been at least 2 ounces of Jameson poured into the tea that Marcus is drinking.
I mean, first of all, I don't think it was 2 ounces. I think it might have been an ounce.
Right.
Let's be honest. I never pour them heavy, and Marcus always asks for a heavier pour whenever I whenever I pour it.
Hey, can I ask you a question? How many times have I had anything other than tea in this cup on this show?
On the show, no. But I mean, anything else we get,
There's been tequila. Tequila.
Listen,
in the cup.
when we were first starting.
the early days.
In the early days, when we were like kind of getting our sea legs, getting our confidence.
Yeah.
There was always tequila.
Do you remember the first time we went live on the radio?
How scared
And they
you were?
And they were like, and Justin, what do you think about, I don't know what he asked. And I just went like this. Yeah. Yeah. It was very, yeah. But look where we are right now.
Honestly, you have, you at the time, you had like very little knowledge and even less confidence. And now look how much confidence you have.
I had knowledge. I just didn't know how to put it into words on a podcast.
Sure. Yeah.
Yeah. Okay, I'm just going to get right into our next Instagram question.
Okay.
You're cool with that?
Yeah.
Hold on. Bringing it up here. Okay. Next question. It seems as though we are in a recession. Very assumptive question. Now, or close to it. But what is next, and where do you see us headed in the next year?
So I think that like we're so negative about things right now
Right.
that the next stop is probably better,
Right.
but I don't think the train's stopping there for very long.
But is it actually better, or is it just going to be perceived better? Yesterday, I was at a concert, and they put this thing up on the billboard that said, just because you're wearing a mask doesn't change who you are on the inside. So, like, is it actually going to be better, or is it just going to be, like, a little more cushier and, like, people are used to it by then?
Okay, so let's quantify better. Better means the psychological barometer of the economy that is the stock market
Yeah.
will be higher.
Right. Okay.
Better means that that consumers will feel a little bit richer.
Right.
Better means that the rise in bankruptcies that we're seeing will pause.
Mm-hmm.
Better means that real estate sales will increase.
Mm-hmm.
Okay, that's better.
That is better.
Okay.
That's better. Yeah.
So I think that we're going to go to better, but we're not going there for long.
Right.
And then we're going to go to worse.
Right.
So like the problem, like that, if you look at what the central bankers are telling you, like if you really read what they are writing and if you listen to what they are saying carefully, they are telling you first and foremost, inflation is the priority. Recession is secondary.
Right.
They're also telling you that it is becoming less and less probable that we will be able to accomplish the goal of reducing inflation while still avoiding a recession.
Right.
And then finally, they're telling you that the biggest fear is that they take the brakes off of the economy too soon and inflation comes back.
Right.
So I believe that this most recent showing from the United States that inflation is abating served to stimulate the market because and the Federal Reserve said in their meeting that it was like, I don't remember exactly the wording, and it's important to know the exact wording, but it was something to the effect of, we see it unlikely that another large-scale rate hike will be required.
Right.
Bank of Canada, everyone was pricing in 50 basis points for the next rate hike. Now people are starting to say 25 basis points.
That's good news.
We got to see Canadian inflation numbers first.
Right.
My brother-in-law, who works at Bank of Montreal, was saying that they most recently have added in used cars into the bundle of goods for CPI.
Right.
Which is quite interesting because used cars will be something that will decrease in price.
Right.
On a month-over-month or year-over-year basis. So it will have an effect of reducing perceived inflation by reducing the CPI numbers. So I think we're going to see some gamesmanship too in these inflation numbers to let the consumer know that, hey, maybe inflation isn't running so hot. They're going to do everything they can to kind of tamp down those inflationary numbers.
Yeah. That's what I'm saying about the mask.
Fuel costs have decreased. Well, how does that run parallel to the mask?
Because
it might not be what you think it is.
Exactly.
Okay, yeah.
You don't like my analogies today.
No, I mean, not just today, but like
you just can't buy bacon from the cow store.
Yeah. Somebody referenced that to me the other day.
Really?
Yeah.
Yes. Yes. I love that.
So I love your questions today. Like, they're great. Yeah, like they're all really.
I mean, they're not my questions. They're users' questions. Yeah. I just picked.
So I think it's going to look rosier soon.
Right.
The same way I was saying, like, people should not run out and travel. Stop going to the restaurant. Save your money right now. There's going to be yet another opportunity to think we're richer than we are.
Right.
Oh, that's a Scotiabank line. Yeah. But there's going to be another opportunity to fall into that trap.
Yeah.
Hold firm.
When we should be like ING and save your money.
Right. ING, which was like the non-bank.
Yeah.
Turned into Tangerine.
And then got bought by a bank.
Yeah, like, what a joke. Welcome to Canada. What a joke. You know, if you are a Canadian consumer and you're in financial services, again, it doesn't have to be Cannect, but like, you're getting screwed everywhere you are. So speak to somebody. Speak to a good mortgage broker. Speak to a good investment advisor. And speak to one that's not affiliated with one of these banks. Please.
Yeah.
Please. Hey, I have a question. Why don't we switch it up? I got a question.
Yeah.
Because I see it. I listen to the Monday morning meetings that you have with the staff. Are you finding that you're getting deals now from other brokers or from customers who are starting to feel like maybe their other brokers can't help them?
100%. Yeah.
So what's going on? Tell me what's going on.
Okay. So with so many changes in the market being like, rate hikes, like property values, like all of these things are creating issues for approvals with people who are working with their banks or other brokers, stuff like that. Right. So, the problem is that we're seeing such an increase on even brokers, right, coming to us and saying, I can't get this deal done for my client. Is there something that you can do to help? Right? Like we have a good reputation. You know what I mean? Like we help people. That's what we do, right? So brokers, clients, all that coming to us. A lot of the problems we're seeing are with appraisals, and the fact that interest rates are going up, and people were previously approved for an amount that they're not approved for anymore. Right? Those are the big two problems that we're seeing.
I remember when I was doing a lot of mortgages, that I didn't like. It's not like I was like running around socializing with mortgage brokers. I had like some buddies who were mortgage brokers. I still do, some good friends. But I found that I would get calls from other mortgage brokers because I taught the course, I guess. So they would call to ask questions. And I don't know why, but it has certainly carried over because I see when the deals are coming in that we're helping other mortgage brokers, which I think is amazing. What I don't like is when we're trying to rescue a file for a customer who went to another mortgage broker or went to a bank, which is far more common, and they told them that they could do something. They said that they could accomplish something, and they were unable to accomplish it.
Yeah.
The key to any business is kind of the under promise, over deliver. Just promising and delivering is cool.
Yeah.
The problem is if you like set the expectations too high and the market's moving against you, it's a real recipe for disaster, and it's really bad for the borrowers.
Yeah.
So I love what I'm seeing in the deal flow right now. I love what I'm seeing, what the team is doing, because not only are we like in a time like this, it's a shitty time for borrowers.
Right.
It is a shitty time for a lot of lenders. It is a really good time to showcase talented brokers,
right?
Talented staff.
Yeah.
Because anybody can get you the lowest 5-year fixed rate when your property value is skyrocketing higher every year, 10% year over year. Interest rates are dropping all the time. Anybody can be the order taker that gets you that rate. And listen, Cannect will always get you the best rate. There's nothing hidden in the way Cannect operates. The lowest rate that we have available is the lowest rate we give our borrowers, and nobody makes a dollar on charging a higher or lower interest rate. But in a time where things like you got to negotiate with the appraisers now, you got to push, you got to lean on appraisers a little bit right now and fight for value. You got to look for comps. Hey, we're doing a townhouse in Liberty Village, and we need the value of that townhouse to be 1.5 million in order for our borrower to refinance at 75% loan to value, get a good interest rate, avoid an inflated premium of any kind, and pay off his unsecured debt. If that value comes in lower, if it comes in at 1.3, that borrower will not have the money they need. It will leave them in a weaker financial position. So you flip it to an appraiser that you know, that you've done a bunch of business with, that you've got other deals for, and you look for some comparables of other townhomes, and you send them to them, and you let them know, I need 1.5 on this. You get it. There is nobody at a bank that's doing that.
No, definitely not.
And hope that there are brokers that do that. But the beauty of how we structured this business is that there's 3 people working on everybody's file, right? And there's 3 people fighting for one file, for one person. And together, all 3 of those people are involved. And they're invested with that borrower.
Band of brothers.
Yeah.
Or sisters.
Yeah, it's great. It's honestly. So I just wanted to say that, like, I normally don't come to all the Monday morning meetings. I have really, I'm going to come tomorrow morning, and then I'm going to leave.
We have a special guest tomorrow.
Oh, Sindhu's here. Yeah.
Sindhu's here.
And then I'm going to leave. I'm going to go to Greece after that.
We started the episode. This is Justin's episode of What Really Grinds My Gears. We started the episode about the banks, like spreading your money on the philosophical bed and making snow angels in it. You know what I mean?
Okay, I like that. Okay,
and now we're talking about people, real people who have real issues or buying a real property, one of the biggest decisions that they can make in their lives, and they're going to banks, like you had just said, and the banks are under-promising, over-promising, and under-delivering, right? And this is like, buying a house, refinancing, paying off debt, getting yourself on the right track. These aren't small decisions for our borrowers, right? And the people who are, it's written into the Bank Act that need to have no history or knowledge in mortgage brokering are able to kind of take these files and maybe not, love them the way that they should be, and then they have to come to us, right? But that's upsetting as well.
You so clumsily said that, but what you said was pretty funny. Is like the National Housing Act.
The National Housing Act
states that people who work at banks are exempt from having any education or training in mortgages. So when you go to your bank and your banker says, don't worry about it, Matt, you're approved. I'm going to make sure you get your hands on that townhouse in King Street West. Number one, you're speaking to somebody who is an employee of the bank and only interested in how much profit that bank will make. Number two, you're speaking to somebody who could know far less than you about mortgages.
Yeah.
Far, far, far less. As mandated and stated in legislation, in an act.
Mm-hmm.
Who thought that it was a good idea to make an act, to make a law that, you know what, if you work at a bank, it's okay. You don't need to know anything about mortgages. You just go and sell them. This is ridiculous.
Yeah. It grinds my gears.
Yeah, that totally should grind your gears.
Yes. Yeah.
What you're going to need to do, though, is you're going to need to wake up and put your big boy pants on. Seriously, man. Like, the bank is not your friend.
Yeah. No.
The bank is the friend to its shareholders.
Yeah.
So if you want to stop being annoyed by the banks, go buy some of their stock.
Right.
And understand that the only people that they are concerned about are their shareholders. Not their borrowers, not their lenders, not their people that are giving them money for deposits.
Mm-hmm.
And if you're upset that the National Housing Act states that the people that work at banks don't need to know anything about mortgages in order to sell them, you should just think like a shareholder. Well, that's probably pretty good because then we don't have to pay these people in order for them to work and learn.
Yeah.
And we don't have to lose them. We can just get a bunch of people that don't know anything in there, and we can get the banker, the top guy who understands how much money and how we're going to make all this profit, to just feed out the most profitable products to people without any liability, without any concern. Great. And then, oh, wow, look, the market is telling consumers that everything's more expensive. Why don't we add in another half a percentage point in profit into our net interest margins to make our shareholders happy? It is a give and take relationship where you need to give as much as possible and they need to take as much as possible until the moment you decide that you're pissed off and you don't want to give anymore. And then they're going to give you just a little tiny bit back. This is the way it works.
Yeah.
You are in an abusive relationship with your bank.
Yeah.
You are in an abusive relationship with your bank. And you need to break that relationship. And you need to make your bank come back crawling on its knees to you, telling you how much it loves you and offering you, instead of chocolates, they're going to offer you lower interest rates. But you need to break it off because you are being abused. You are being told no far too often. And you will find that you are worthy. And if you pick up the phone and you call someone who knows what they're doing, they are going to love you much better than your bank is loving you. Cannect will love you better than your bank.
Oh yeah. We love hard. Is that weird?
When you stare at me like that, it's a little weird. All right, listen, I think that's the show.
That's it.
Yeah.
That's it. We aired our grievances.
You grinded your gears?
I grinded my gears, and now we're gonna continue on with our Sunday. I'm gonna have tacos for dinner. What are you gonna have?
I'm going to my mom and dad's.
Oh, that's nice.
Yeah, I don't know. I think my mom is making veal cutlets. So like, my mom is an amazing cook, right?
Okay.
And we didn't have a lot of money when we were growing up. Okay. And my mom we loved veal cutlets. Okay. It's like tenderized, thin little pieces of veal. My mom fries them, breaded, like the whole deal. Like I think you take them, you put them in egg or flour, egg, and then breadcrumbs.
I don't think you need to explain a deep fried anything to Justin.
That's fair.
Go on.
Anyways, when we were little, my mom would make these veal cutlets. And then one day I was like, oh, mommy, I'll help you make the veal cutlets. I just like to help her make it so that like I could stand next to the frying pan and like eat a couple while they were coming off.
Yeah.
And I keep my mom company. Hey, you know what I mean? Anyways, one day I saw her take the veal cutlets out of the fridge and they were pork cutlets. I was like, hey, what's going on here? I thought these were veal cutlets. Oh, usually they're veal cutlets.
Just not today.
Not today. I was like, huh. So I started paying attention. Always pork cutlets.
Yeah.
So now I called my mom. What are we having for dinner tonight? My mom was like, we're having veal cutlets. In the back of my head, I was like, I was not pork cutlets. I love you, mommy.